So temporary working capital, as I told you yesterday, that it is additional amount of cash, stock, and debtors that you require sometimes in business. Maybe because your business is seasonal, or maybe there is sudden increase in demand of your product, and for that you need to maintain extra stock of goods that you deal in. And because of your additional sales, you will also have additional debtors, and you'd be requiring more amount in form of cash to meet your regular expenses, which now would be more than earlier. So it is not required on continuous basis, but only when the need arises. So, right, guys? I hope you all can hear me and can see the screen. Anushka, Navneet, Ashutosh, Hunar, and Ahana. Right?
Yes, sir.
It can be further classified into the following two. First is seasonal working capital. So if your business is season based, then season you would be requiring more working capital in those seasons where demand for your products is higher than any other season. So needed when a business deals in seasonal products where demand is high during a particular season and very low in other seasons. For example, in summer season, when we have more demand for electricity, that time in most of the states there is power cut by state government, and that time many business houses they need generators. Similarly, umbrella, woolen clothes are examples of such seasonal businesses. The second is spatial working capital. So this capital is needed on special occasions which are not known in advance, like when demand rises suddenly. For example, in your city there is a match of T20 tournament, and because of that lot many guests are coming visiting to your city, and because of that suddenly demand of food items, whether it is vegetables or milk or any other item, has increased. So these are examples of special occasions. When there is depression or recession in the economy, or when there is strike, natural calamity, strikes, etc. These are other examples when you require additional amount of working capital, like further supply of goods have decreased, and you know that there would be strike in some days, and therefore you want to maintain additional stock than your regular stock. Have you understood this, guys? Spatial working capital. Now, guys, factors that affect requirement of working capital. So some businesses require lesser amount of working capital, some businesses require more amount of working capital. Why it is so? Behind that there are some factors. Let's understand them. The first is nature of business. This point we already saw under the factors affecting requirement of fixed capital. So here also the same point is there, nature of business. If your business is service business, you will require a very lesser amount of working capital as against having a manufacturing business where you require stock of raw materials, stock of work in progress, stock of finished goods, stock of goods in trade, stock of stores, spares, consumables, and then debtors, cash, and bank balances. So manufacturing businesses require more working capital as it has different types of stock, like stock of raw materials, stock of WIP, stock of finished goods, and stock of spares and consumables. On the other hand, in trading businesses, there is only one type of stock, that is stock in trade. In service businesses, there is no stock at all, and therefore you require very least amount of working capital, mainly for your debtors and for cash and bank balances. That too, if you are dealing in credit sales. Next is scale of operation. This was also there as one of the factors responsible for amount of fixed capital. So when your scale of operations is large, when you have large number of production, then you will require more amount of working capital as against smaller scale of operations. The bigger the volume, that is production or turnover of business, higher the amount of working capital required and vice versa. Higher turnover means higher sales of stock to be maintained and higher amount of debtors. Right guys, when your sales would be more, you will have more debtors. You need to maintain more level of stock. Third point is manufacturing or production cycle. If you are dealing in smaller products such as FMCG products or semi durable goods, then manufacturing cycle would be of lesser number of days, and because of that your money would be stuck in working capital for lesser time period, means lesser amount would be stuck in working capital. Then if you are into business of bigger products which takes time into production, so the time from acquisition of raw materials to their conversion into finished goods is called manufacturing cycle. जिस दिन आपको रॉ मटेरियल मिला उस दिन से लेके जब तक आपने फिनिश गुड्स बनाए तब तक जितना भी टाइम लगा है वो आपका मैन्युफैक्चरिंग साइकिल है. Longer the cycle, more would be requirement of working capital and vice versa. बिकॉज़ जितना ज़्यादा लंबा आपका प्रोडक्शन साइकिल है, उतना ज़्यादा टाइम के लिए आपका पैसा प्रोडक्शन में स्टक है, फँसा हुआ है, वो तब तक आपको रिकवर नहीं होगा जब तक आप उसको बना के गुड्स को सेल करके कस्टमर से रिकवर नहीं करते. The length of manufacturing cycle depends upon the type of product being manufactured and the nature of technology being used. For example, in case of products like cars and cotton textiles, the production cycle is much longer than in case of items like stationery, detergents, etc. I hope you all understand this, guys. Correct? Fourth point is inventory turnover rate, that is rapidity of turnover. How fast you sell your goods which are ready for sale, which are not into production, that also decides your working capital requirement. So if inventory turnover rate is higher, then you will require lesser amount of working capital. And if inventory turnover rate is lower, then you will require higher amount of working capital. So you have already finished inventory or finished goods with you in your hands, and now you have to sell it. But in sales also you take a lot of time. Then for that period, your money will remain stuck in the finished stock. As against this, if you can sell it immediately, as soon as you get it from your production or from your suppliers, then you would be requiring lesser amount of working capital. So inventory turnover rate refers to the speed at or the time period within which finished goods is converted into sales, that is into cash. A firm having higher inventory turnover rate needs lesser working capital as against a firm which has low inventory turnover rate. So working capital requirement has inverse relationship with inventory turnover rate. Do not forget this, guys. This inventory turnover rate or inventory turnover ratio you also have in your financial accounting. It is so because the firm with high rate can manage with less investment in stock. आपको ज़्यादा दिन तक स्टॉक अपने पास रखने की ज़रूरत नहीं है क्योंकि वो तुरंत बिक जाता है, इसलिए आपको स्टॉक कम अमाउंट का रखना है और इसका मतलब आपका कम पैसा फिनिश गुड्स के स्टॉक में फँसा हुआ है. Take the case of a retailer dealing in fast moving items like groceries and cosmetics with a high turnover rate, and that is why he requires lesser amount of working capital. Its investment in stock is bound to be much less than a retailer who is dealing in slow moving items like ready made garments or electronic goods. Right? So, groceries and cosmetics are our daily needs. They are fast moving goods, and that is why turnover rate there is always higher than as against durable goods like ready made garments or electronic goods. Fifth is terms of purchase and sale. If you are purchasing your goods on credit and selling them in cash, then you will require lesser amount of working capital. As against if you are selling goods on credit and purchasing them in cash, then more working capital is required. Why? Because you need money to immediate for the immediate payment to your suppliers, but your customers are not paying you on time, rather they want credit. So when purchase is done in cash and sale on credit, more working capital is needed than purchasing on credit and selling in cash. So it totally depends on the customs of the market in which you are operating. This is not in your hands, guys. Right? I hope you have understood the fifth point. Correct or not? If you have good credit policy, that is the tightened credit policy where you give lesser period of credit to your customers, then you would be requiring lesser amount of working capital because your lesser money would be stuck with your debtors. But if you are giving liberal, or you are offering liberal credit policy to your customers, then your more money would always be stuck with your debtors, and this is how you'd be requiring more amount of working capital. So a firm allowing liberal credit, that is great for more days with no limit of credit. No limit of credit means a customer can purchase goods of any amount from you on credit. Then you require more working capital than the other firm allowing strict credit policy with limited amount of credit. Understood, guys, this point? Ashutosh, Hunar, Anna, Navneet, Anushka. It is so because when customers are allowed longer period of credit, a larger amount of firms' funds get tied up with debtors. Seventh is operating efficiency. If operationally you are very efficient, then you will have lesser wastage of raw material, you will have lesser wastage of finished goods. You'd be producing and selling goods by using limited resources, and thereby you'd be saving a lot of resources, and this is how your working capital requirement would be less. So a firm can reduce the requirement of its working capital by keeping control on wastage of raw materials, designing better and fast procedures and methods of handling and processing of raw materials. So when you have such fast procedures and your workers are trained enough, then there would be very less chances of wastage of raw materials. Faster movement of finished goods in market for sale, and for that you need to have warehouses across different corners of the market where you sell your product, because presence of warehouse will make your distribution faster. Faster recovery from debtors. You have a collection agency which does this act of recovering money from debtors instead of you doing it, or you have a separate team for collection, and then they keep pestering your customers to make payment on time, and this is how you can have faster recovery from your customers. This will reduce the level of raw materials, finished goods, and debtors, and thereby the requirement of working capital. I hope this point is also clear to everyone, right, guys? Next is growth and expansion plans. If you have in near future growth and expansion plans, then you would be requiring more amount of working capital than a stagnant firm where there are no chances of growth and expansion. Because when you grow your business, you'll be requiring more amount of stock, you'll be requiring more cash in hand to meet increased operating expenses, and thereby requirement of working capital would be more. Next is level of competition. Higher level of competition forces businesses to keep variety of goods and large quantities to meet sudden large orders, and this is how your requirement of working capital would be more, as against a monopoly where there is no competition at all. So what's your quantity you keep, that all will get sold because you are the only seller in the market. And allow liberal credit terms to customers. So because of competition, since others are also giving liberal credit, you also have to give, otherwise you soon would be out of market. So level of competition also decides amount of working capital that you require in your business. Both of these cause requirement of higher amount of working capital. Then there's cyclical fluctuations, that is recession, depression, boom, recovery. All these are cyclical fluctuations which every business, every economy has to suffer from. So during boom, the sales would be very high, and because of that, you need to have higher amount of working capital. As against this, the requirement for working capital will be lower during the period of depression when the demand remains low. However, guys, working capital does not go in proportion to your demand. Do not forget this. When demand goes up, your working capital requirement would also be high, but not as much as increase in demand. When demand goes down because of recession or depression in the economy, your working capital requirement also goes less, but not as less as decrease in demand, because still during depression and recession you need to maintain some fixed expenses, and for that you should have money in your hand. 11, seasonal factors. Those dealing in seasonal products require larger amount of working capital during peak season. This we have already seen in temporary working capital, guys. On the contrary, the level of activity as well as the requirement of working capital will be lower during the lean season. Lean season means when you have less demand. 12th, goodwill of business. If you have good goodwill in the market, then your suppliers would be happily ready to give you goods and services on credit, and this is how you need to put in lesser amount from your own pocket in working capital towards stock and debtors, because most of your stock and debtors would be financed by your creditors only, by your suppliers only. So firms enjoying goodwill and high credit worthiness can easily and quickly arrange short-term loans from commercial banks. This is how they can reduce their own contribution for working capital. And apart from getting short-term loans from banks because of good credit worthiness, you also get credit from your suppliers. That is not mentioned here, guys, but I have already explained you that for point number 12. So when you have good credit worthiness in the market, financial institutions would also be ready to give you short-term loans, as well as your suppliers would also be give you supplies on credit. 13, inflation and deflation. You all understand what is inflation and what is deflation. So when inflation is there, prices of almost all goods rise significantly. And because of that, raw materials also become costly for you and you need to pay more for them. And this is how working capital requirement would be more, right? On the other hand, during deflation, prices of everything, including prices of your finished goods and prices of your raw materials, will go down, and because of that lesser amount of working capital would be required then. During deflation, the requirement for working capital goes down as prices of raw materials, labor, etc. go down. Am I clear? Understood these 3 points? The next one is, guys, difference between fixed capital and working capital. The basis is meaning. So what is the meaning of fixed capital? Capital which is invested in fixed and long-term assets is called fixed capital, and capital which is invested in short-term, that is current assets, is called working capital. Time span of investment and fixed capital. For a long period, your money remains stuck or tied up because these assets do not have faster recovery of their cost. On the other hand, for in working capital, your money is tied up for a short period. Circulation, fixed capital hardly gets circulated, it remains fixed. That is why we call it fixed capital. But as far as working capital is concerned, it keeps circulating from one current asset to another, like from cash to stock, from stock to debtors, from debtors again back to cash. Sources of capital, for fixed capital, we usually look for longer sources of finance, and those are shares, debentures, and long term loans, and even retained earnings. For working capital, we require short term sources of funds or finance, that is public deposits, trade credit, short term loans. Trade credit means credit that you get from your suppliers. Public deposits can be accepted only by companies, not by partnership and proprietorship businesses. Short term loans are available to everyone. Purpose, the purpose of fixed capital is to generate income, whereas the purpose of working capital is to maintain liquidity in the business to meet day to day expenses. Another term for fixed capital, the other term is called block capital, because once you put money in your fixed assets, it gets blocked. But in working capital, it is not blocked. It keeps circulating from one asset to another, and one day it comes back to you in form of money, which you again have to reinvest in the business. And that is why it is called circulating capital. I hope, guys, you have understood that also. Correct or not? So, guys, this is how we have seen fixed capital and working capital along with their types, factors that influence them, and their differences. Any question that you have here, guys? Anywhere? I'm asking everyone, guys. So, guys, after this, what we have from tomorrow is tomorrow we will have class, guys, and will longer classes would be there. And I hope you all have stopped making any plans. Why? Because your exams are very nearby, right? So we'll have longer classes. I will tell you the time by tonight. And in commerce, tomorrow we will have class for CBSE students first. That is for financial decisions, right? So that's it for today.